Hi, Matthew here and welcome to another video. Property versus stocks and shares. This thought got me wondering, as a buy-to-let landlord, how well has my property portfolio performed in the past 12 months during the pandemic versus stocks and shares? Now obviously this last year has been an exception to any rule when trying to make some sort of long-term investment strategy. However, in times like these, it is a great opportunity to take stock of any investments we have, figure out whether we could be more proactive with them, diversify a little bit, and generally see whether we're missing out on other opportunities elsewhere. If you stick around long enough, I'm going to reveal later in this video which investment that I made in the past 12 months has been my best performer. Now then, the UK housing market. Figures released just this last week or so suggest that the housing market is up 7% on average. So from January 2020 to January 2021, the average house has gained £16,000 in value and is worth slightly in excess of £250,000. So hypothetically speaking, what if in the last 12 months I had exactly the same exposure to the stock market as I do to the property market? If we do a quick comparison, I've got the data from my rental portfolio and how that's performed over the past 12 months. And in the past 12 months, I did actually make some investments in the stock market. Now, a little disclaimer, I'm not the riskiest of investors. We won't be comparing the property market to the likes of Bitcoin. That would be ridiculous. After all, property is considered a safe investment. The expression safe as houses did come from somewhere. So the comparisons we'll be looking at are what might be considered the stocks and shares equivalent to the property market, if such a thing exists. I was looking for something long-term that would hopefully follow the historical upward trend of the stock market, a similar experience to being a buy-to-let investor. Right, let's jump back to January 2020 and establish some base level starting points for both stocks and shares and the property market. If we start with buy-to-let property, according to some figures released recently in The Independent, the average landlord now owns around 2 properties. The average value of one of my own buy-to-let properties is around £135,000. So therefore, a landlord with the average 2 property portfolio would have the equivalent of £270,000 exposed to the property market. We will therefore use this figure of £270,000 to calculate and compare how the same amount would have performed in the stock market over the same period of time. My exposure to the stock market was by way of 3 index tracking funds. They were the HSBC FTSE 250 Index Fund, and in that you had the likes of Weir Group, Games Workshop, Direct Line Insurance. The second is a Legal and General UK Index Fund, and in there you've got the likes of AstraZeneca, GlaxoSmithKline, Unilever. The third is a Legal and General US Index Fund, and in there you have the likes of Apple, Amazon, Facebook, Visa, Tesla. So as you can see from these 3 funds, they're all invested in the well-known big blue chip companies. Nothing too complicated, nothing too risky hopefully, a diverse mixed bag. The stock market equivalent of the property market maybe. For me personally, these were a comfortable level of risk. So let's now see how these performed over the past 12 months from January 2020 to January 2021. If £270,000 was invested in the HSBC FTSE 250 fund, that would actually now be down 4.5%, which is £12,150. The same amount invested in the Legal and General UK Index Fund, that would be down 9.5%, which is a loss of £25,650. And finally, in the Legal and General US Index Fund, that one's actually up 17%, which is a gain of £45,900. So quite clearly, by far the best performer in the past 12 months is the Legal and General US Index Fund. Now, as for property, well, as we know, that is up on average 7%. So therefore, in theory, a 2 property portfolio worth £270,000 would actually have gone up £19,000 in value. So clearly that quick comparison between property and the stock market It's clear to see that properties performed relatively well. However, the best place to have been for the past 12 months would have been in the Legal & General US Index Fund. However, that is of course not the whole picture when it comes to these types of investments and buy-to-let. In reality, if we are wanting to assess what the effect has been on our total worth, then we do need to factor in the likes of dividends and rental income. Now, with regard to dividends in the past 12 months, well, due to the pandemic, these have either been slashed or cancelled altogether. Current expectations appear to be around about 2% at best. With a 2% dividend, we could therefore expect £5,400 of income. Now, the three index funds I've just referred to are actually accumulative, so that income would effectively be reinvested automatically. And with regard to rental income, well, over the past 12 months, I have personally been very fortunate with the pandemic. I still managed to collect 98% of rent on time and in full. Therefore, with me achieving a 6.5% yield approximately on a £270,000 investment, the rental income for that 12-month period was in effect £8,660. So we're now in a position to compare the overall performance of being invested in stocks and shares compared to being invested in property over that 12-month period. So in the last year, an investment of £270,000 entirely invested in the HSBC FTSE 250 fund, that would now be down £6,740. The 270k invested in the Legal & General UK Index Fund, that would be down £20,000. Invested in the Legal & General US Index Fund, that would actually be up £51,000. And if the 270k was in property for that 12-month period, that would actually be up £27,000. Now, there are of course slight adjustments necessary for these calculations based on the ongoing charge of having the index funds, and also, depending on circumstances, the cost of financing any property investment. It does, however, give us an indication of real-world performance in the past 12 months. We can clearly see that the place to have been invested for capital appreciation in the past 12 months is the Legal & General US Index Fund. Now, we're not quite finished there. There is always a very strong argument for timing any market, whether that be the stock market or even the property market, and I haven't been entirely honest. I haven't actually been invested in those three funds since January 2020. In fact, I only got into them around March 2020 when the market had bottomed out due to the pandemic. This was after the FTSE 100 had dropped 40% of its value and the FTSE 250 was down from its peak by 50%. So of course that changes everything, but it does give us an opportunity to look at how timing makes such a difference. First, if we look at the HSBC FTSE 250 fund, since I actually got into that in March 2020, I've experienced 56% growth. Therefore, that £270,000 hypothetical amount that we were working with could in theory have gained £150,000. The Legal & General UK Index Fund, now I actually got into that even later in 2020. I delayed by about 10 weeks, so that was around the beginning of June. That 10-week delay actually cost me the majority of the growth in 2020. So therefore I've actually only gained around 11%. And finally, the Legal & General US Index Fund. Again, I delayed getting into that one around about 10 weeks as well. If I'd got in at the bottom of the market, the growth at this point would be 45%, but I've actually only experienced 17%. Of course, there are no surprises that with such volatility in the stock market at the moment, it was bound to provide lots of opportunity to significantly outperform property. There are always winners and losers with stocks and shares, and nothing has been a sure thing, and we've just confirmed how important timing is. I think one of the main takeaway lessons from this hypothetical scenario is that the basic and fundamental principles of buying stocks and shares and buying property are very similar. With buy-to-let, if you buy the right property with good foundations, that hasn't had its potential developed yet, in the right area or market that can grow in popularity, and if you pay the right price, then you maximise your potential to see growth. The stock market, exactly the same. I did say at the beginning I was going to reveal which investment had seen the best performance over the past 12 months and during the pandemic. Well, there's actually two that stand out. The first is Rentokil. They're listed on the FTSE 100. I did manage to buy in at the 52-week low, which was a bit of a fluke. But I have seen strong growth of around 80%. The second is Moderna, as in the Moderna vaccination. I'd closely been following the Pfizer situation, and knowing that Moderna were lagging by around about 2 weeks with revealing their results. I then managed to buy in around about the week prior to their results going public, got out 30 days later, and had growth of 120%. Anyway, thanks for watching. Feel free to give the like and subscribe a quick tap, and I'll be back again soon with another video. Thank you.